What's going on, guys? This is Lior and welcome back to my channel. Now, what I thought I would do in this video is give you guys an overview of how I structure my real estate buy and hold deals. So I'll talk about all the different components that go into it, including the debt and mortgages, the equity and private investors, and how I put everything together through my LLCs and operating agreements. So I'm gonna give you guys exactly how it's all structured together, and we're gonna get after it right now. What's going on, guys? My name's Lior and welcome back to my channel. Now, as I said, I'm excited to talk to you guys about how I structure my buy and hold real estate deals. So I'm gonna get into all of the details behind the scenes. But before I get into it, super quick, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button for me. I put out tons of new videos every single week talking about buy and holds, case studies of my projects, walkthroughs of my projects, financials on investing, and everything in between. So if that's the kind of content you're looking for, make sure you subscribe to the channel. So with that, let's get right at it. And as I said, I'm gonna be talking about how I put together the different components of a buy and hold real estate deal to structure it all together. And I'm gonna start off by talking about the debt/mortgage side of the equation. So if you guys have been watching my videos, you know that typically what I do in around the Boston area is I buy what's called value add real estate, right? So basically I look for opportunities where real estate is mismanaged or needs some sort of work, right? So basically my business plan is to buy an asset below market value, right? Below what it'd be worth if it was completely renovated or producing at top dollar, and essentially either do some sort of construction or stabilization work to bring up the rents, bring up the condition of the property, and stabilize and essentially create value or equity in the deal. So for that, I need to have certain types of financing structures. And for me, what I typically need is, on the mortgage side, is a loan to not only acquire the asset, but typically also funds to do some sort of renovation, right? So I need an acquisition loan and a construction loan together. So typically I will use two different sources of financing on the mortgage side. I can either use hard money lenders or I can use local community banks. Now, each one has their advantages and disadvantages, and I've talked about them in other videos, but at a high level, let me give you guys an overview. So hard money loans are great when you need to move really fast for a deal, right? There's been circumstances in the past where I've been told, look, Lior, you can grab this deal at this price, only if you can close in like 2 or 3 weeks, right? And the thing is, with hard money lenders, they can move very fast. I've closed deals as fast as 10, 14 days. Whereas if a regular local community bank where I'm gonna go get a commercial loan from them, typically will need at least 45 days. So that's one discrepancy right there. Now, both also offer different term structure, right? So hard money lenders tend to be more expensive because they're so fast. So typically the interest rates you're looking at is anywhere from 9 to 12%, depending on how experienced you are. Plus, they're usually 12-month term loans, right? So that means you go in, you borrow the money for a year, and then you have to repay it whether you're selling the asset or doing a cash out refinance. You're also gonna have things like points involved with hard money lenders, right? So typically when you're doing a hard money loan, you're probably gonna have anywhere from 1.5 to 2 points of the total loan amount due at closing, right? So it is kind of an expensive loan. But the nice thing is too, hard money lenders can be a little bit more flexible, can get a little bit more creative. I've seen hard money lenders go as high as 85 to 90% of the acquisition loan, right? So 85 to 90% loan to value, which only means you as the borrower need to provide 10 to 15% of the down payment, and they will also lend you 100% of the construction funds. On the other hand, commercial loans from local community banks, they have their own advantages, right? Their loan to values are certainly lower. Typically, we get a 75% loan of value for the acquisition, right? Which means we have to put 25% down, but we will typically get 100% of the construction finance to us like a hard money lender. But the interest rates and closing costs are much lower with commercial loans from community banks. Typically, we're looking at rates from anywhere from high 3s to maybe low mid 4s. So very similar to your classic residential loans. And your closing costs are much lower. Typically, the most I'll ever get charged is maybe half a point, right? So depending on the deal structure, depending on how fast you need to close on everything, those are the two different types of financing methods on the mortgage side that I will use to finance my deals. Now, the next component I usually have to figure out on my deals is the equity side, right? Because regardless of whether I use a hard money loan or a commercial loan from a community bank, I'm gonna have some sort of down payment, right? Whether it's 10%, 15%, or 25%, I need to put some sort of down payment down, which is called the equity component, right? And not only that, but when you're dealing with value add deals, right? Typically what happens is because the property's, obviously not performing as good as it should be when you're buying it, you're typically gonna be losing some money the first year you buy, right? Because either the rents are super low or you're just gonna be doing all construction and you're not generating any rental income. So while you're doing this process, you're going to be losing money, right? So there's certain soft costs that go along with doing these projects. Not to mention if you're doing construction, you're gonna have other costs like surveying, architecture fees, potentially zoning attorney fees, and all that. So basically, as the investor, you're gonna need funds for that down payment as well as those soft costs. So if you wanna do a lot of projects at once, it's hard to fund that yourself. So the model that I've taken is I basically partner up with what I call capital partners, right? And these capital partners come into my deals and they provide the necessary funds for me for the down payment and soft costs, right? And in exchange, I give them a percentage of the deal, right? So let's say a capital partner comes in for, my average deal, which might be like a 3 to 6 unit in Boston, which will probably cost me, let's say, somewhere around $1 million, right? Typically, I'm raising about $300,000, and in exchange for that, they will get 50 to 55, maybe 60% ownership in the asset, right? So they get 50 to 60% of the ownership of the building. I maintain 40 to 50% of the building, and then I obviously execute on the business plan. As the investor, you have to coordinate your equity, make sure it's aligned with your interests, make sure it's of course aligned with your investor's interests, and make sure it kind of all fits together and you're properly structuring your deals for the project's benefits. So once you will have that all figured out, now we're gonna talk a little bit about the actual logistics of putting this all together, right? And because I use these commercial loans, right, whether it's a commercial loan from a community bank or it's a commercial loan from a hard money lender, the way I have to structure things is by creating a separate entity for each project, right? So each one of my projects that I do has its own separate LLC, right? So let's say I'm buying 123 Main Street, right? Classic example. I'm gonna open up 123 Main Street LLC for each project, right? And basically what's gonna happen is that capital partner I partner with, right? When we come to an agreement, they're going to fund those funds into the bank account of 123 Main Street LLC, right? So each LLC has its own operating bank account, right? And I usually just, I'll either go to Bank of America or I'll use a checking account from the bank that I'm working with. So they'll fund those funds into that bank, into that operating account. We'll sign what's called an operating agreement, right? And an operating agreement, if you're not familiar, each is a document that spells out how each LLC works and is structured, right? So in that operating agreement, it'll spill out what are my responsibilities as the managing member of the LLC. It will spill out my duties, responsibilities, and it'll also spill out percent ownerships and capital contributions, right? So if someone's investing $300,000, if John Doe is investing $300,000, it's gonna say John invested $300,000, he owns 55% of the company, and then Lior owns 45% of the company. So basically, it's a very clear document that outlines exactly how everything is structured within the LLC. So we signed that agreement between me and the investors. The investors fund the deal. They put the funds into the operating account, and then me as the person that's executing on the ground can go use those funds and close on the property, right? Provide the funds for the down payment. I'm gonna be the one that actually signs on the loan, right? So I'm the one that's signing on the loan, which means I am guaranteeing that entire mortgage amount. So if anything goes wrong with the project, all the liability falls on me rather than the investors. So I'm signing the loan docs, and then once all that comes together, we then have our property, we have our LLC, we have our operating agreement, then we have our operating account, right? Which in theory should have additional funds after closing, right? To essentially pay off any soft costs and holding costs while we're doing our stabilization work. And then we can get to executing the project on the ground. So I know I spelled out a lot of detail, and obviously this can be a little bit of a complex structure, and there's certainly variability depending on project per project basis. But that is the general outline of how I structure my deals. So if you guys have any questions, concerns, ideas, whatever it is, make sure you put them in the comments below and I will definitely help you out.